Thank you for listening to this presentation on increasing cash flow for the oil and gas industry. How oil and gas companies can increase cash flow by reviewing property, sales, and severance tax opportunities. I will be focusing on E&P and midstream companies, but certainly opportunities exist throughout the oil and gas industry, including oil field services and downstream companies. Before we jump in, I'll provide the standard legal disclaimer and introduce myself. The material appearing in this presentation is for informational purposes only and should not be construed as advice of any kind, including, without limitation, legal, accounting, or investment advice. Now to introduce myself. My name is Marty Tschida. I am a principal at Moss Adams and have been practicing since 2007. I co-lead the oil and gas practice in the Denver office, where I provide consulting and compliance services in state and local taxation. I work in all states in which oil and gas exists and have a deep passion for the industry. States I predominantly work on are my home state of Colorado, the great state of Texas, Wyoming, Utah, New Mexico, North Dakota, Oklahoma, Pennsylvania, and Louisiana. I also do federal ONNR and tribe work. I've spoken at numerous events including COPUS Revenue and Tax Committees, COPUS Education Days, API Severance Tax Conference, North American Petroleum Accounting Conference, and others. I do both compliance and consulting services, including actual tax return preparation, refund reviews, process implementation, and other types of consulting work. The opportunities I'm presenting today are based on my experience in preparation of the following filings and the review of previously filed items. Before I begin, I do need to highlight the limitations company have in timing to file and receive refunds. This limitation is referred to as the Statute of Limitations. If taxpayers delay and file after this imposed date, refunds will generally not be allowed. For sales and severance, the statute of limitation is between 3 and 6 years, depending on tax type and jurisdiction. For property tax, generally we see a shorter period, from a few months up to 3 years. The first opportunity I wanted to speak on is property tax. This tax is one of the largest annual tax expenses companies in the oil and gas industry pay. The tax itself is based on value. The value of the equipment, the value of reserves, the value of the facilities, and therefore determining that value can save cash flow and reduce effective tax rates. Some of the opportunities that should be reviewed is functional obsolescence. This opportunity reviews the level of capacity of an asset versus overall usage. For example, if a pipeline is being used at 10% of its capacity, 100% value on that asset would not represent fair market value, and therefore a certain type of factor would need to be implied in order to ascertain the correct value for property tax. The next opportunity is valuation of hydrocarbons. This looks at the two main ways reserves are valued for real property tax reporting, either based on future cash flows or based on actual production. For future cash flows, proper decline curve analysis, LOE, and other items should be reviewed. For value based on actual production, as with severance tax, the point of taxable value is typically not the value that is received for the hydrocarbons sold. These hydrocarbons are sold downstream after substantial transportation, processing, and other benefication occurs. Reviewing LOE, depreciation, return on investment, among others, is paramount to getting the correct value for taxation. The next item is asset valuations. Having a proper valuation done on assets can determine value, including fair market value for tax purposes. Reviewing drilling rigs, facilities, gathering systems, field equipment, all of these items where we're determining fair market value can have a asset valuation done to see if your value is higher or lower what's on the roll for the counties. The next item is an asset review. As oil and gas companies own a substantial amount of assets, it can be cumbersome to know what assets are out in the field during the regular course of business, let alone when acquiring a company. Reviewing assets to determine overstating equipment, removed equipment, or even omitted equipment can reduce tax liabilities and mitigate risk. For property tax, if your in-house preparers or outside tax preparers are not asking you operational questions and inquiring about your business on a yearly basis, you probably are overpaying. I've ran across companies that have been filling out the same data request for over 10 years and providing that to their tax consultant without any further discussion. It is easy to recognize the problem with this, as operations have surely changed in 10 years, let alone the deductibility or perhaps even the mapping of accounts have been closed or adjusted. To do property, or as I get into severance tax correctly, data needs to be actively analyzed and operational questions need to be asked. If not, taxpayers could be overpaying. These opportunities should be utilized immediately for property tax, as again, property tax statute of limitations are typically short. At the same time, due to the current pandemic, protest periods have generally been extended. And therefore, by reviewing property tax, companies can both reduce outlays of cash as well as reduce the effective tax rate for property tax that are currently being accrued. The next opportunity is sales tax. Capital expenditures in the oil and gas industry are substantial. Companies are drilling wells, installing equipment, building gathering, processing, and disposal facilities, and in a number of states, these expenditures may be exempt from sales tax. In this case, companies can review a number of opportunities to file and receive refund claims from both state and local taxing jurisdictions, some with interest. The first opportunity is a bundled transaction. In some states, services are exempt from sales taxation, and therefore the tangible personal property that is used or consumed within that bundled transaction could be deemed exempt. Cementing, fracking, fishing, mud jobs, these are all potential targets in certain states. The next opportunity is manufacturing equipment and pollution control expenditures. Pipes, tanks, VRUs, separators, weed control, plants, gathering lines, and other equipment may qualify for refund depending on use, location, and other factors. Tax rate analysis is another opportunity. Viewing the proper tax rate shown on an invoice compared to where the transaction actually occurred could result in refund claims. Many vendors have the wrong address or the wrong tax jurisdiction on a specific invoice, and therefore companies may be overpaying. The next item is the buy-sell transaction. Ensuring that proper sales tax or use tax was paid on a transaction, as well as determining the proper allocation of that sales price between equipment and reserves, can result in substantial tax savings. The last opportunity I wanted to present is severance tax. Severance tax is a unique tax for the oil and gas industry on the value of severed hydrocarbons from the earth. Jurisdictions value hydrocarbons in a variety of different ways, but generally will value severance tax based on the volume or value produced. Valuation based on value is a complicated endeavor as location, quality, and operational differences, point of valuation, and other factors can dramatically impact value and corresponding tax. And many companies I've ran into either use in-house preparers or outside accounting groups to file severance tax returns. While this will get the return out the door, in my experience, having these inside revenue accountants or outside accounting groups prepare returns will generally result in overpaying tax. They simply are not tax experts and are not keeping up with the changing exemptions, deductibility, or credits. And therefore, here are a number of opportunities that exist for severance tax. The first is a review of credits and exemptions. In certain states, exemptions are available for a reduced tax rate, credit, or reduction in tax. Workovers, stripper wells, high-cost gas wells, inactive wells, and other opportunities should be reviewed. These credits and exemptions can be broken down into statutory or via an application process. If companies have not filed the proper application, some states allow taxpayers to go in time, file late exemption forms, and still be able to capture some type of benefit. The next item is valuation of hydrocarbons. Similar to property tax, this can be a formidable task. Reviewing LOE, marketing contracts, division of interest, owned assets, and other items can be reviewed and applied to reduce the taxable value. Companies need to think of severance tax as not a cost of doing business, but an actual tax filing, and really looking at the point of valuation for severance tax. Similar to property tax again, Taxpayers should not be paying tax on the value that they receive from the hydrocarbons, but on the actual point of valuation, which could be much further downstream than the actual sale price. If your company is paying severance tax, a review right now can help to reduce the effective tax rate as well as put cash back into your business. In other items such as allocation of deductions or buy-sell transactions, these can all be reviewed to ensure that proper deductions are being allocated between tax types and wells, as well as on buy-sell transactions to ensure that each company is fulfilling their responsibility on reporting those royalties on their specific severance tax return, or also determining which company is going to be allowed credits on their severance tax return in the year of buy or sell. Thank you very much for listening to this presentation today. As you can tell, there are numerous avenues to explore to increase cash flow via property, severance, and sales tax. However, companies again need to act soon as refunds associated with this tax paid are expiring. Please feel free to contact me if you have any questions regarding the slides, tax opportunities, or simply would like to know more information. I'm always happy to have a conversation or to do a high-level scope of data to see if there are potential opportunities.